Welcome to Understanding Revenue, part of the continuing MyCloud MBA resource series. This video reviews terminology associated with the financial concept of revenue. If you have not done so already, complete your diagnostic assessment after viewing this video in order to receive your business aptitude scores and begin improving your organization. Professional groups, such as doctors and engineers, have developed specialized languages to facilitate communications within their communities. While words commonly used in daily conversation, such as profit and income, are often used interchangeably, financial analysts give these terms very specific meanings. And depending on context, the incorrect use of specialized jargon could cause confusion. Revenue is receipts from customers for products or services sold, typically for cash, but sometimes with deferred payments and no cash. Revenue and cash, therefore, are not synonymous, and a business may generate revenues but actually run out of operating cash. For purposes of simplicity, let's assume cash is always received at the time of sales, and no accounts receivable is created, a concept discussed in later videos. In financial statements, you'll see the terms sales, revenue, or gross revenue to describe products or services in exchange for money. While often used interchangeably, MyCloud MBA uses sale to mean an individual transaction between a business and a customer, and gross revenue as the accumulated sales over a period of time, such as a month or a year. Adjustments to gross revenue for customer returns or discounts from list price yields net revenue. To avoid confusion, MyCloud MBA will include the modifier net or gross whenever required. With an entire pie chart representing gross revenue, net revenue is what's left over after removing returns and discounts. For simplicity, the label returns will include both discounts and refunds on previous sales. When accountants say revenue, most of the time they actually mean net revenue. Removing cost of goods sold from net revenue leaves gross income. Cost of goods sold are direct costs associated with selling a product or service and include food used in restaurants, metal in fabrication, fuel in trucking, or hourly labor in construction. They specifically exclude fixed expenses like utilities, rent, and indirect labor, such as bookkeepers and management. As a variable cost of goods sold changes in direct proportion to revenue, and may also be known as variable expenses, direct cost, or simply costs. Gross income, also known as gross profit, therefore increases or decreases directly with gross revenue and cost of goods sold. When expressed as a percentage, gross income is called gross margin, gross profit margin, or simply gross profit, and is probably the most important financial number you should track. Answering the question, do you make money on every sale? A negative gross income indicates a non-viable business heading towards insolvency. Purchasing a can of corn for $2, for example, but selling it for $1 results in a negative $1 gross income, and selling more cans only worsens the financial outlook. Removing operating expenses from gross income leaves operating profit. Operating expenses refer to most fixed costs not part of cost of goods sold and includes rent, utilities, and indirect accounting and management labor, but specifically excludes interest, taxes, and equipment depreciation. Operating expenses are also known as fixed expenses, other expenses, or simply expenses. Operating expenses generally do not change as sales go up or down and are considered the fixed costs necessary to keep your doors open. A positive gross income, but a negative operating profit indicate a business in trouble, but likely still viable and easier to correct than if gross income was negative. Options for improving operating profit are cutting fixed operating expenses or increasing gross revenue. The old joke about losing money on every sale, but making it up in volume actually applies to a negative operating profit. Good practices require allocating variable direct costs to cost of goods sold and fixed indirect expenses to operating expenses, but accountants have some flexibility based on the product or sophistication of the financial system. Hourly manufacturing labor directly attributable to individual items is typically considered cost of goods sold, and labor spread out over all items, such as accounting or engineering, is considered indirect and part of fixed operating expenses. Inability to collect and allocate direct labor costs, a situation commonly encountered by small business, may force accountants to consider all labor as an operating expense. Proper allocation between accounts doesn't actually change the net amount of money, but it does help correctly analyze the business. Operating profit is also known as earnings before interest, taxes, depreciation, and amortization. Operating income is what's left over from operating profit after subtracting depreciation and amortization. Depreciation and amortization are allowances for long-term purchases and capital investments. Operating income is also known as earnings before interest and taxes. When you deduct interest and taxes from operating income, you have net operating income, or NOI. Finally, subtracting one-time and all remaining expenses, or adding income from investments or one-time sales of property from NOI, and you're left with net income. Net income is the money you can actually take home and spend, or distribute to your shareholders. In summary, net revenue is what you sell. Cost of goods sold is the direct cost necessary to make and sell products and is most influenced by suppliers and direct labor. Gross income is the money made on sales. A business losing money at this point is likely not viable. Operating expenses are the fixed costs to keep a business open, regardless of sales volume. Operating profit is the money left over after removing fixed and variable costs from net revenue. Operating profit increases by selling more product and fully utilizing existing fixed infrastructure. In addition to the gross revenue takeaways, gross margin and operating margin ratios check on the financial health and are reviewed in our Understanding Margins video. We also have the Income, Cash, and Balances video, helpful in understanding your business-to-business financial status. Make sure to complete your diagnostic assessment to begin improving your business today. The contents of this video are the property and opinions of Experdyne. While great care has been taken to ensure its value and accuracy, subscribers are responsible for determining suitability within their business or personal affairs.